Well, good day all. Good day all. This is George. We're going to be talking a little about a specific area of Fibonacci, which occurs time and time again in the markets this morning. Before we get going, just want to double check once again that everyone can hear and see the presentation, and then we'll get started. Fine. Thanks, Joe. Thanks, Pat. Chrissy. Yeah, Philip. Excellent. Well, good to see you all in the room this morning. And here we are. We're in August, which tend to be the sort of the dog days of summer, if you like, in terms of markets. We've got a number of participants who are not around, and traditionally, things do tend to, for Forex, tend to sort of die away a wee bit. But we then get these quite interesting market moves, which we've got plenty to keep the Forex market well and truly buzzing at the moment. And of course, amongst these is what is going on in Ukraine to some extent, what is going on in the Middle East. We found that the dollar has recovered strongly, and we've then got the euro situation, which has now come back center stage once again. So there's plenty buzzing around, and in these slightly thinner markets, we are getting some really quite reasonable moves that are going on. So we're going to look at one specific aspect of that. Now, I realize that there's a pretty wide, broad church of experience in the room today. So just bear with me for about 5 minutes while I just sort of go through some of the basics of Fibonacci. Now, you know, there are going to be one or two people who just don't use Fibonacci at all. So could you maybe give me a little indication of, are there any absolute Fibonacci beginners out there? So if I don't receive any, yeah, okay, we've got, we've got one or two. Some are right. Okay, fine. Okay, right. That's great. So we haven't got a group of Fibonacci experts out there, but equally we haven't got a group of total beginners. We've got a fair mix, as I rather expected. So just bear with me for a moment. Fibonacci originated sort of way back, and in the very early Middle Ages. And there he was, 13th century mathematician, and he came up with this number sequence. And it's a dead simple sequence, 2, 3, 5, 8, 13, 21, and so on. And you know, what actually happens is that you just add the numbers together. You add the last two numbers together, and you get the next number. And of course, it just goes on in infinity. And there was he applied it. Fibonacci apparently, it is reputed that he applied it to the reproduction of rabbits. You know, you get a couple of rabbits together, obviously a male and female, and you know, they'll produce some more rabbits, and so on and so on. And so you end up getting this sequence that runs on. Now, there's been a certain amount of mysticism attached to it, in that if you see a seashell on the seashore, try saying that when you've had a few whiskies, and it's produced this sort of this spiral effect. You can just pick them up, you know, if you're sort of wandering along the beach, anywhere in the world. And it's the Fibonacci spiral, that comes up. So you get the numbers, they're observed in nature, and it will be observed in the length of your arm in relation to the length of the forearm, that's 61.8, etc. It's in architecture, it's in so many things. And consequently, there are those who look on Fibs as a religion, almost as a religion. So what I do just want to point out, though, is that this golden mean, okay, it's found then by dividing adjacent Fibonacci numbers, and the result is 1.618, and then the golden section, as they call it, is 0.618. And there are a whole series of numbers which are derived from taking the square root of that number. Now, that's the nuts and bolts of the origin of it. We've got a little picture here of a man, and you can see the 50% level. you can then see where the various other levels come. The 38.2, which of course is the opposite of 61.8, and you can then start to use a grid on the human body, and you'll find these numbers come up time and time and time again. Okay, in aesthetics, it's said that beautiful people have perfect Fibonacci relationships of the eyes in relation to the nose, to the mouth, and the width of the head, etc. So we've got architecture, the pyramids, the Parthenon, and so on. And you can pick up a petal. And once again, you can observe all sorts of these different Fibonacci numbers. So we now come down to the charts, and here we are. We've got a move from left to right. Okay, we've got a corrective move and then a move on up. And look at this, a corrective move, lo and behold, comes down to a Fibonacci level before it carries on up. So what about this mysticism? Is it something which we really should sort of gaze up into the stars, up into the gods, and be thankful for it? Or is it something else? Well, to me, it's something completely and utterly different in that these ratios of the 61.8, 38.2, etc., it's a self-fulfilling prophecy. Now, I primarily trade Forex, and donkeys years ago, of course, in the Forex market, Fibonacci was totally useless. Before it became really popularized, before Forex was the flavor of the month that everyone wanted to trade, when it was not that easy to in fact open a Forex trading account, nobody used it. Absolutely nobody used it. And then over a period of time, a number of traders did start to use it, and more and more and more. And there was WD Gann with his 50% retracement. Over a period of time then, it became a self-fulfilling prophecy, purely as so many traders use it. And now it is so widely used that any trader who's not using it is really missing a trick. So what are we going to use it for? Well, what we're using it for, both predicted levels, where we expect price to actually go to, but we can also use it in the moment, so that when we've got price at a particular level, and here we have this 78.6 level, which is a derived ratio. It's one of those, which is one of the square roots that I was talking about. In Forex, the 78.6 level is vitally important. It is very, very, very important indeed. So here we've got an idealized view where we've got from top to bottom, and then we've got the retracement, and that is a typical Fibonacci Forex market retracement up to 78.6. Okay? And if you hear anyone saying otherwise, well, just ignore them. So we quite often will get reversals at those levels. And what I'm really most interested in are price extensions, and to a lesser extent, things called expansions. So we're not worried about anything really other than a price extension. And this is it. This is the hub of what we're going to be looking at today. So let's just consider we've got a price move from a high to a low. Okay. Price then does a bounce. Inevitably, there is going to be a bounce. There 99.9% of occasions, well, 100% of occasions, there is always going to be a bounce. Always. Okay. And the bounce will very often look a bit like this, in a zig move, a zag, and then another zig. And the swings that we run on, well, very often they're very, very similar. And they can be very similar in terms of the vertical distance traveled. Okay, bottom to top, that's the first swing. And then the next swing on the upside from bottom to top can very often be the same distance. If it is the same distance, it's called a measured move. But equally, we find that we don't get the measured move every time that we're looking at this. But what we do get more often than not is the second part, the second upswing, is going to be a Fibonacci multiple of the first swing. It might be the 61.8, it might be the 78.6, which is very, very common, or it might even go more than the measured move, up to 138.2. So that's what we're looking at today. We're primarily looking at today. So let's just touch more detail. We can start to talk now in terms of a little bit of Elliott wave theory, because this is a part of Elliott wave theory. And Elliott wave theory tells us that we are likely to get an A, B, C move. So it's sometimes useful in a trend and sometimes in a counter trend move. So the way in which we want to trade this then is that if we can identify an A move, which is just a straightforward move against whatever the prevailing trend was, with a B move, which will probably move down in the direction of the dominant trend, but it then comes to a halt. We want to be entering at the end of the B move. Now, quite conveniently, what we very often find is that if we were to put a fib grid on the extremities of the A move, bottom to top, we very often find that the B move comes to an end at one of those Fibonacci points. And that helps us identify that reverse point of B. So we just might be fortunate enough and have a nice little bounce from the B level. Okay, conveniently do that. We might even add a little bit more to it. And that little bit more could well be a confirming candle. We might get a hammer candle, a key reversal bar, or maybe an Harmonic. And we might also be identify some volume coming in at those levels, or indeed just drying up completely, giving us an idea that price action then is ready to reverse. So we tend to see it on a whole series of different charts, and it's not exclusively Forex, although the examples we're going to be looking at today, the real charts, they will tend to be Forex, but this just happens to be a gold chart. Now, this whole pattern that we're looking at is actually part and parcel of a bigger pattern. So let's just focus on the A, the B, and the C for a moment. What we've got then is from a high, price comes on down. It comes on down. It's a counter trend move. We then get the B move that runs on up. And this B move has got momentum behind it, but then this momentum just dies away. And just in the apex there at B, we can actually see that we've got one of these rather strange doji pin bar type candles, which very, very often do show us what a reversal is going to be. And that's exactly what does happen. Price then starts this B move on the way down, and the distance it travels is exactly the same as the distance traveled in the A move. That is a perfect measured move. Now, we won't just look at the bigger pattern, because the bigger pattern, I don't know if anyone can identify this pattern. The overall pattern shows that where C came to, it came down to this level of where price action spent a little bit of time. Now, each one of these candles is 30 minutes. So any offers on what this overall pattern actually is. Any offers? Any suggestions? So in this area of where you've got prior price action, that's very, very often where price will actually gravitate to on a correction, and a correction this is. Now, the overall pattern correctly said, yeah, brilliant, excellent, folks. Yeah, this overall pattern is a Barclay pattern. Now, it's got the characteristics of Barclay 2.2, and it's got the characteristics also of the butterfly pattern. But the key thing is that what we've got is a full pattern, it's a full harmonic pattern, where price then has followed the rules absolutely perfectly, in that the move down the C came out of a very, very clear ABC move. So this is a perfect Barclay pattern. What we then look for is the buy zone, and the buy zone is going to be in this region then at C, and we're looking for price action. Immediately following this, well, we've got a series of candles here which are suggesting that price is not going to go down any lower, and then it perks up and gets moving. Anyway, we're not going to look too closely at price action today. We're just looking at this phenomenon of this measured move, and it's associated with Fibonacci numbers. Now, let's just look at another one. A little grid on here, and what we can see is that we've got a downswing. Okay, well, it started with an upswing, but then we get a downswing that swings almost right the way down to where it actually started from. We then get a bounce on up, and lo and behold, the B move after this A move down stopped at a 61.8 retracement. Okay. Then we get the next move on the downside, the C move, and the C move has now gone below these previous levels of support, and lo and behold, down it went, only to find that the C move is exactly the same as the A move. So if you actually get that, if you see that phenomenon, despite the fact that this is actually broken to a new low, and the breakout traders would have been just selling this like crazy, just this one little bit of knowledge might stop you selling with the crowd. Because what was actually going on there, and what this was ready to do, was to actually bounce. And as we can see, that's exactly what it did. It bounced up from this C move. So just that one little bit of knowledge can take us away from what the majority of traders do. And what the majority of traders are doing is that they tend to sell new lows and buy new highs, which so often, particularly in the Forex market, is a fool's game. Yeah, absolutely, Ian. Yeah, absolutely, Ian. Yeah, it's the same as saying A, B, C, D. There are, different ways of just using the old nomenclature, if you like, but you're absolutely right. So we could say that's an A to B, and then we get a little bounce. Some might call that a C to D, but it means exactly the same thing. Right, so there we are. That's a measured move, and we can sort of see this in a market. This just happens to be the Aussie, which is a pretty good market for Fibonacci and following these general rules. On this particular one, it's 15-minute chart, and we've got a whole series of these measured moves that we can see. We get a retracement, and it runs on down. So we've got an A move, a B move, a C move. We then get yet another leg where this one, we'll call this the A move this time, the B move, and the C move. Now, there's also a little bit of Elliott wave here, and we've got a wave 1, a wave 2, a wave 3, a wave 4, and a wave 5. And we're going to look at this in the real sort of market in just a second, how those waves do relate to each other. But we get another one here. Look at this. From this low, it runs on up to just over a 50% retracement. It then corrects, so we've got an A move on the upside, a little correction, lo and behold, to a 50% retrace of this main move. That's the B move. And then we've got a C move that runs on exactly the same length. Or I should say exactly the same vertical distance. Now, there's a little bonus to be added in that the horizontal distance is going to very often be exactly the same as well. And when it is, then that adds so much more weight to it. And Donald, that word has been put to this so many times. It is absolutely amazing how it works. And you're quite right, DB, that it's a nice little gargly because it bounced up to 78.6, and that then gave us a gargly move on the downside, and it just ran on through. And these relationships just continued. Now, as we sort of ran this one on down, you can see that this move from the 78.6 high there, again, that's the A move. Then we've got the B move. Then it came down for a C move, and we can see that the measured move came down there to just above the 87 level, just above the 87 level. And in terms of Gartleys, that was target one. It then continued right the way on down, and it moved to just under 150% of that move. So it went beyond a measured move. And that does so often happen. So what this effectively did then, it moved on down, and you're quite right, Davey. It came down to very similar to a butterfly pattern. So what we're looking at, Mr. C, is this is a previous chart, an idealized view. So what we'll do, we might just go and switch over and look at the real market right now. So bear with me while we just chop this out. Let's go take a look at this. Now, can you see a chart there? It's a 4-hour chart, 240-minute chart of the AUD USD. Can you see that? I'm asking that question because quite often when I switch over here, it doesn't switch over neatly, and it has. Fine. Okay, Mr. C, Pat. Thanks a lot. Right. Well, let's just have a little glance at this, at what we're looking at. That must be a 4-hour chart. I've got the automatic fib finder on here. But what I just want to use as a sort of a general observation is that on this 240-minute chart, and we've got a whole series of waves, what we can see on this move. Let's just take, for instance, let's just take this little move, okay, from this peak. Put a horizontal line across so that you can see what I'm talking about in relation to the rest. And then let's just look at this low. Now, this low just happened to be the same as the previous low. Donald, it is absolutely. This is a current chart. This is what is going on right now, or at least right the way over here on the right hand side of the chart is live. So if we were just to look at this move on down, and I'm just going to use the measuring tool that there is in TradeStation. Now, what you can see is that if we call that the A move, and then we get the bounce to the B move, I've now measured this on down, and look where it's come. The 100% is actually lower, but it didn't go to 100%. It went to just beyond 78.6. So a 78.6 move is very, very common indeed. It's very common indeed. Let's look at another one. Let's just take this move from the low and we'll run it to here. Okay. See where I'm just running it to at that level. I'm then going to project it up from the little move that it had. So we could call this move the A move. Then we've got the corrective B move. And then we've got the run on up. And notice on this one that it went a little bit further than 100%. It went a little bit further than 100%. It went into the region of that previous high. It actually did break above it, almost touching 138.2%. And as you can see, it did hit a couple of the other important Fibonacci numbers. So it hit the Gartley level, and it hit the false breakout reversal level, where price just goes above a previous high, or indeed below a previous low, and it'll reverse just after the level. They tend to be stop runs, by the way. They tend to be stop runs. So they tend to be false breakouts. In fact, you can call them all sorts of things. What I used to call them a spring, but they're very, very useful things to trade. And then, the point that I then want to make is that not only can you trade the C part of the move, but when the whole pattern completes and you can see it as part and parcel of a bigger pattern, then what we have actually got is an excellent trading position to take. And as we can see, this one ran on down. Now, while we're just looking at this, I guess that we can do a little bit of predictive level. And one of the first predicted areas with the Gartley pattern is the region of, in this case, the previous low. Well, prices have moved on below that, and adjust this ever so slightly so that you can actually see the numbers. It came down to this 112.8 level, and then it decided to reverse, and it reversed with a pretty powerful day, or at least I should say not a full day, but the net effect was it was a powerful day, but that 240-minute candle reversed quite strongly. So where are we now? Well, it moved on up. It then put in this engulfing candle, which unfortunately was in the wrong place, and consequently price then did not follow through any further on the upside, and so it's now starting to move sideways. If it drops below this candle, this green candle, then the expectation is that it's going to go lower, but there's a possibility it might find that it's got a bit of power to actually move higher. So there we are. That's one that just wanted to take a little look at. What we can do is to look at the shorter term as well. So if we come down to a 15-minute chart, now we've got lots and lots and lots of lines on here at the moment. In fact, let me just let's switch this over to a 20-minute version. That's right. Made it just ever so slightly tidy. And we've got a whole series of swings up and down. Well, let's just look at this that went on this morning, much earlier this morning. Now, a number of people in this room, they're not... yeah, Sharon. Sharon, overall, you're absolutely right, but it's attempting to rally against at the moment. It's attempting to. Well, it was earlier, and we're just at a critical level. If it breaks this low, then the chances are that we're going to see it just sort of resuming its downward move. And that would be consistent then with the dollar continuing its up move. So if we were just to look at this little move on the way down, I'll measure it. So we've got, you can see it's picked up a butterfly level. So we've got an A move to here. Then we've got a little B move that runs on up. And then we've got the C move that runs just over 100%. And it runs to the 112.8% level that we actually looked at that. So we tend to get these moves time and time and time again. So how would you trade this? Well, if we were trading first thing this morning, UK time that is, but whatever your time zone is, it may well be a particularly social time for you. Certainly not for me, regrettably. But we could then participate in this next leg down. Once the leg down has been completed, and lo and behold, it hits a Gartley level, then we need to switch over and move ourselves out of bear mode back into looking for the possibility of a rally. And of course, we got the mother and the father of a really strong rally this morning, moving it on back up. Yeah, we can do that, Sharon. We can certainly look at, let's go and find the New Zealand dollar. Is that something you do trade regularly? Maybe it's in your time zone. Right, okay, so let's just take a little glance at this. I'll just take off the ATR on this daily chart because it's showing us that we've got an ATR about 50, what you can see we've got 51, 52 pips of an ATR, average true range. Let's just disable that. We've got the ATR stretch on here, which is at the moment not showing that it's moved a massive distance. But what we have got on the daily chart is really quite an interesting possibility of a reversal. Let's just put a little bit of space on those, and let's just measure what we've seen on this little correction. So we can take that then as being the A move. Oh, that's great. And then we've got the B move, and then we've got a superb C move on the way down. And this has actually illustrated yet another little Fibonacci feature of the ABC move, and that is that this one has come down to 138.2%. And it's decided that level is also coincident with a BAT level, an 88.6 level retracement. We then get candle action on last Friday that actually just told us that it was definitely not going to go any lower for the moment. Now, we don't really know. We can never actually predict with certainty. All we can ever do is to do a little bit of prediction with just considering the odds. And the odds suggest that at very least, at the very, very least, it's going to pause in this region. And that's exactly what it has done. And it's almost suggesting that what we could well be getting is a bounce. And where would this bounce likely go to? Well, we've got a gap. And it's a vacuum, if you like. A gap is a vacuum, and vacuums tend to be filled, always tend to be filled. So there we are. That's a quick glance at the longer-term New Zealand dollar. Quite interesting, the New Zealand. I was actually over there earlier this year, and I was with some people, and we were looking at all of the features that made this a particularly strong currency, and of course the New Zealand dollar fundamentally has got an awful lot going for it. The only problem is that they rely a tremendous amount on exports, and a strong New Zealand dollar is not really too good for export. And of course, interest rates, their housing market, particularly in Auckland, has just gone totally balmy. They're in a bind because they want to have higher interest rates to choke off things like the housing market, etc. But of course, what do high interest rates do for the currency? And where you've got strong fundamentals behind it, it wallops the currency far too high. So they're only too pleased to have this semi-engineered move back down. There's another little feature on this chart, which I will just mention. If I put a line across there, we can actually see that we've got gaps on both sides. Could this be, and this is a question for you, this is just a rhetorical question, could this be an island reversal? Yeah? Could that be a little island all by itself? You'll see much lower levels there on the New Zealand dollar. Well, absolutely, it could be. I think we'll leave that one hanging there for the moment, literally hanging there to sort of see what's going on. Come right down to the 15-minute chart, and we're seeing some support and resistance come to play. We've had price this morning nip up to a back level. It's then pushed its way on down, and it's found another back level. And we find that time and time again, price bounces between these Fibonacci levels. Right, okay. Now let's go and take a look. I'm actually pleased to look at one or two other things, but let's just go and look at one of the most heavily traded at the moment, which of course is the euro. And let's just take a glance at the 30-minute chart. Now, we've had the euro just selling off like crazy, and it's something to do what Mario Draghi wanted. He wants a weaker euro to try to improve the prospects of the export performance in the eurozone. We've got all these central bankers, and they're all one-trick ponies at the moment. They're all saying, if we can have a weaker currency, it actually makes us more competitive abroad. The only problem is their trading partners don't like it because it makes their exports uncompetitive. So, it's the net result is that it actually helps nobody in the long run. It doesn't help our collective world trade. What helps collective world trade is actually stability. But I don't think we're going to get too much of that anytime soon. So, absolutely, trade war through currencies. So what we've got, if we can just sort of have a look at this little move from Friday, up price went, it came on down. It moved up quite substantially. It then came down again, and it moved up yet again. So on the day, that was a major move, reasonably major move. It went from 33.80 to 34.40, 60-pip move. So, without a doubt, yeah. There are little pockets of stability, and you tend to see those in the Nordic currencies to some extent, in the Swiss, etc. But of course, these main currencies at the moment, they're just being pushed in all sorts of different directions. Anyway, coming back to the point I was going to make, we can actually divide this into 5 waves: wave 1, wave 2, wave 3, wave 4, and wave 5. And let me just measure wave 1 in relation to this wave 5. And what we can see is that it's come up to 161.8. And again, you get these measurements which come up time and time again. So I guess that I'm sort of making a bit of a commercial today, a commercial for making full use of Fibonacci in your trading. Now, we've got another ABC move from the high down to this low. We then get this corrective move running through this morning. And where has it gone? We've got that number again. And that number is just beyond the 100%. And it's gone just beyond the 112.8%. In the region of the previous low, this is exactly where we would expect to see a fair bit of support. And I mean, it's also worth mentioning that on a typical swing, where the euro tends to move in a swing of around about sort of 40 odd pips. That's its sort of regular sort of swing. About 38 to 40 pips is a sort of move that can be expected. Okay. And what we've seen is that this move is approximately that. And so if we've had a swing that moves in that sort of 40 odd pips, then, you know, we would, at the very least, be expecting to find something of a correction here. Right, so that's the euro. What else should we go and look at? Let's just have a quick look at the Japanese yen, which again is one that's been, I mean, gold. Well, okay, bear with me. Let's just quickly look at the yen, and then we're going to look at gold. Right. Let's just do a quick snapshot of what's going on here with the yen slightly longer term. Let's work this out weekly. As we know, the yen has weakened like crazy against the US dollar, and it's gone through a sideways move. We get these little 5-wave runs every now and again, and it's been running sideways now all of this year, waiting to break out. It's trying very, very hard to break out on the upside. What seems to be happening is that the situation with weakening the Japanese yen in order to make its exports more competitive, and by dint of that, they seem to think that it was going to help their domestic economy. The only problem is it is not. Quite the reverse effect. Look for the upcoming next lot of GDP figures, and you will find that the domestic economy in Japan is shot to pieces. However, we've had a nice little run on that, had a bit of a correction, and one wonders if it's going to break out, we're going to get another move up to this 104 level. It seems to suggest that that's what it wants to do at the moment. But let's just come right the way down to look at the 30-minute chart and look at some of these swings. Well, look at it. We've got a beautiful little swing on down. A, B, C move. Let's measure it. From the high, okay, to the low of the first move, the A move. We'll measure it down from the corrected top, and where does it come to? Well, 100%. We've got tails that ran below 100%, but in that region of 100% is where we've got consolidation, and that's where price decided to break on up. So once again, we've got a corrected move, an ABC type move, and that ABC type move, once it was completed, gave us a level at which we had a beautiful buy level. We look again, and we've got this little move up. We've got an A move, a B move. Didn't quite make the 100%, a little bit more than the 78.6, but you know we've got a move that's completed. We can then play around with things as simple as trend lines and find out areas where we actually want to put our trades on. We can look at this little move. An A move, a B move, and a C move. And look at that, not quite to the 138.2% in the region of the previous low. Oh, and by the way, it hit that all-important back level. So we get these time and time and time and time again. Right, okay. Yeah, I mean, quite, yeah, dollar line, yeah. Well, that's a good question. That is the Forex market run for the benefit of Forex traders and world trade, or other things? Well, you know, that's a question indeed. Right, what's going on with the gold? Well, gold needs inflation to really, really get moving. And the simple fact of the matter is that we've got all this QE going, weakening the currencies, and consequently, you know, that should have the effect of making commodities which are priced in dollars that much more expensive in dollars now because by virtue of the fact there are so many more dollars available. But it also needs inflation, because without inflation, you can bung all those dollars in, but the overall economies of the world are actually contracting. And that's what's going on at the moment. And that's what's stopping gold really taking off. But we've still got a whole series of moves that we can play around with. Look at this one. We've got a little A move there. We've got a B move, and then it comes down to a C move. And look at that. Just over the 78.6% level. And we've now got this pause. The big question is, which way is it going to come out of this pause? Is it going to break on the upside? Is it going to break on the downside? We've certainly got this area of a pause in the region of the 61.8 retracement, and it's entirely possible that from here we could possibly get a very, very useful move. Now, it might be up, it might be down. So we just watch what is going on with price action, particularly after yesterday's Hallmey, then we could well be positioned quite neatly to go and make some money out of it. Right, so there we are, folks. I've just gone through some of the things that I look at on a daily basis. You know, I look at these composite set of charts. I'm looking at these important Fibonacci levels that actually come up. I use my bit of software here, my automatic Fib finder, which actually tells me, so I don't actually have to put it on. I can see at a glance where these levels actually are. And what this is telling me, for instance, just looking at the slightly longer term on this Australian dollar, it showed me these levels of interest. And these levels of interest are where we actually want to sort of make our moves. We've got several there on the Australian dollar. And you're quite right in identifying that chart. That's exactly what we've got. Today, we have got dollar strength, looking very much as if it wants to go for another major leg up. And it would appear that we could do a little bit of wave analysis, and let's just do that. We've got a wave 1, we've got a little corrective wave 2. Okay. It then ran on up to 100%, so we've got the measured move correction there. But then, if we look at what is going on today, which could be a fifth wave, we can look at that little measurement and say, right, well, you know, it could move up to somewhere between 81.80 and 82. That would be the most likely level that it's trying to gravitate to. Right, okay, folks. If you want to get in touch with me about any of this stuff, if you want to, if you want to sort of look at my program, which is the Harmonic Wave Trader, which is well worth taking a look at, which actually encompasses pretty well everything I've talked about today, in, of course, a great deal of detail, then don't hesitate to get in touch. Let me just give you my email address, which you can just get in touch with me at any time. george@clickevents.co.uk. Anyway, been great to have been with you, and look forward to being with you next month. Bye for now.